But when someone says silver in the low 40s makes more sense over time while gold remains elevated, I don't hear a guarantee. I hear something more grounded, a fairness argument. An attempt to realign silver with a world where gold is already trading at high levels, inflation hasn't disappeared, and silver continues to sit at the intersection of industry and money. Now think about this for a moment. If gold stays strong and inflation lingers, does it really make sense for silver to stay behind forever? A tube of eagles reaching into the high hundreds one day doesn't sound impossible to me. Not overnight, but over time. Pause here, and let me ask you something. What day are you watching this? Drop the date in the comments. And if you want more straight, no-nonsense breakdowns like this, hit subscribe and comment so I know you're serious about this kind of content. Now, let's get into what's been circulating lately. There's been a lot of noise, rumors about a massive trading firm building a huge silver position. Then suddenly, silver explodes upward in a move that shocks almost everyone. And just as quickly, it gets slammed back down. So naturally, people start asking questions. Is the market rigged? Is paper silver just an illusion? Did everyday investors just get played? At first glance, it's easy to understand the frustration. It feels wrong. It sounds outrageous. And honestly, some parts of the story do deserve your attention. But here's where things start to shift. When you slow it down and break it apart piece by piece, the picture becomes clearer and more useful. Some claims hold weight. Others, not as much as they seem, and that distinction matters more than most people realize. Let's focus on what we actually know. Earlier this year, silver made a historic run. It surged past 100 and even touched above 120 intraday. That wasn't hype, that was real. But what followed was just as dramatic, a sharp and aggressive reversal. By the end of March, prices had dropped significantly, settling back into the high 60s range. Let that sink in. That kind of volatility can leave investors confused, frustrated, or both. But here's the key question. Was there a real reason behind the move? The answer is yes. Recent data shows that silver is still operating in a supply deficit. Investment demand continues to grow rapidly, even while some industrial sectors soften slightly. This isn't just a social media trend or chart pattern. It's rooted in actual supply and demand dynamics. So no, this didn't come out of nowhere. Now here's where it gets even more interesting. The trading firm at the center of these rumors isn't some unknown player. It has already faced serious regulatory scrutiny overseas. India's market regulator even issued an interim order accusing the firm of manipulating an index-linked setup, involving hundreds of millions of dollars under restriction during the investigation. The firm has denied the allegations, but that's not the point. The point is this: there are real factors at play here. Real movements. Real pressure points in the market. But the story isn't as simple as rigged or not rigged. And if you want to understand what's really happening next, you have to look deeper. People aren't making up this controversy. There's a real paper trail behind it. But this is exactly where things usually go off track. Let's slow this down for a second. A lot of people hear all of this and jump straight to a very extreme conclusion. There's no silver behind any of this. It's all fake. But that kind of thinking? It's too broad, too careless. And if we're serious about understanding this market, we can't afford to make claims we can't actually back up. Here's why that matters. The major silver fund everyone keeps mentioning does publicly report large physical holdings. According to the latest available data, it showed roughly 500 million ounces held in trust near the end of March, with assets worth tens of billions, and its own prospectus clearly states that the trust primarily holds physical silver with a custodian. Now pause here. Does that answer every concern about paper silver? Not even close. There are still valid questions. How the structure actually works, who can redeem, and who can't. Custody chains and transparency market impact from large inflows, and ultimately, who really benefits? Those are real concerns, but saying there is absolutely nothing there is a completely different claim and a much harder one to prove. And this is where most people make a mistake. When arguments become too extreme, they actually weaken the valid points. They make serious concerns easier to dismiss. What's the stronger argument? Not that everything is fake, but that price discovery in a relatively small market like silver can be heavily influenced by flows, leverage, positioning, and big money moves. And that's a much more realistic and much more dangerous idea, because it means ordinary investors often react late, not early. Now, before we go deeper into charts and market mechanics, let's step away from the screen for a moment, because this is where things get real. While the internet debates manipulation and billion-dollar trades, somewhere there's an old trader recovering from injuries. The shop closes for a day, not for strategy, but just to breathe, to heal, to regain some balance. Think about that. Coin tubes waiting to be sorted. Boxes stacked, ready to ship. Orders coming in from real people, not algorithms, not institutions, people who actually care about what they're holding. And here's the part most people forget. Every massive headline, every spike, every crash eventually ends up in someone's hands. On a counter, in a package, in a collection. That slower world, the physical side of the market, is easy to overlook when everything is moving fast, but tells you something important, that you've got a business adjusting in real time. Heavy lifting passed on. Doors closed one day a week. Not as a loss, but as a necessity. It may not look impressive. It won't go viral, but it's the difference between chaos and control. And that Wednesday closure, it sounds small until you really think about what it means. Or maybe it's the exact opposite. That one quiet day, it's not a loss, it's a lifeline. Think about it. That's the day everything gets sorted. The Eagles, the Rounds, the Maples, the Brits. The odd lots, the customer holds, the outgoing orders. The misplaced items finally get found. Packing materials get restocked. Calls get returned. All the small things, the ones people ignore, finally get handled before they turn into real problems. And in a market like this, an organized day isn't a luxury. It's survival. Now, let's shift gears for a second. Shipping. This is where things get even more real, because shipping isn't just printing a label and moving on. It's detail. It's precision. Box size matters. Weight matters. Distance matters. Shipping to a nearby state might be manageable, but scale things up and suddenly everything changes. Packages get awkward. Space becomes a risk. You start improvising, trying to make things fit safely with whatever you have left, and that's when something bigger starts to happen. When a dealer says direct wholesaler shipping might become the norm, it's not some random business decision. It's what happens when reality catches up with a small operation. Let that sink in, because this is why the precious metals world is about more than just the spot price. Yes, price matters, but so do premiums. Availability, labor, handling, timing, trust, and one question most people never think to ask, is the person on the other end even physically able to do the job today? That's not on any chart. But it's real. Now here's something even more powerful. One of the strongest parts of this entire story has nothing to do with hedge funds, regulators, or exchange products. That it's the mail, the handwritten notes, the small packages, the unexpected gestures. Get well soon. Happy birthday. Even candy, sent by someone who simply cared enough to send it. And then there's this, a young buyer. A kid stacking silver with birthday money, holiday money. Sitting with grandparents, learning, watching, trying to understand this world early. Pause for a moment, because that changes everything. Now, the market isn't just theory anymore. It's not just charts and headlines. It becomes human. And once that happens, the real question isn't whether big players can move a small market. Of course they can. The real question is, what does that mean for someone building slowly over time? What does it mean for the person who isn't trading headlines, not chasing quick flips, not trying to outsmart the market, but simply trying to save piece by piece? In something they believe in. That's where the heart of this story lives, not in the loudest claims, not in the scariest rumors, but in the gap between how fast powerful players can move and how steadily regular people have to live, because the kid buying one coin at a time doesn't have the same tools, the person nearing retirement doesn't have the same speed, the small shop trying to stay afloat doesn't have the same flexibility. So when silver surges and then suddenly reverses, yes, regular people can get caught in that move. But here's the key question. Does that mean there's one mastermind pulling every string? Or is the truth a little more complicated than that? Not necessarily. And this is where I want you to really think for a moment. A violent move on its own is not proof that there's one hidden hand controlling everything, that it's easy to jump to that conclusion. It feels clean. It feels simple. But markets, especially a market like silver, are rarely that simple. So what actually happened? Recent reports painted a clear picture of the silver run earlier this year. This is a relatively small market, and because of that, it's naturally vulnerable to squeezes. Now combine that with a powerful mix, tight supply narratives, rising momentum, growing retail interest, stop losses getting triggered, and leverage stacked on top of all. What do you get? You get a move so aggressive it almost feels unnatural. But here's the twist. Sometimes that kind of move isn't just manipulation. It's the market feeding on itself. And that's where things get complicated. Because acknowledging that doesn't mean manipulation never happens. It means the cause isn't always just one villain pulling strings behind the curtain. Now think about what that implies. If a market is small, emotional, and heavily leveraged, then yes, it can be pushed around by large flows. And for the average person, whether we call it manipulation, distortion, or flawed price discovery, the outcome can feel exactly the same. And that's the real concern. Now, let's pivot for a second because this next part might seem like a detour, but it's not a let's talk about copper at first glance. It feels unrelated. But it actually reveals how people in this space think that on one hand, physical copper has obvious limitations. It's bulky. It has a low value relative to its weight. Once it's turned into novelty items, the premiums can get expensive. And if you think in terms of storage or barter, it becomes impractical fast. So yes, the instinct is right. For most people, stacking large amounts of physical copper doesn't make much sense. But don't stop there, because on the other hand, copper's importance is very real and growing. This isn't hype anymore. This is policy. In the United States, official sources have become increasingly vocal. Copper, and even silver, have been included in critical minerals lists. Supply chains tied to these metals have been highlighted as essential for national security, defense systems, infrastructure, and advanced manufacturing. Let that sink in. That's not fringe discussion anymore. That's mainstream strategy, and the supply situation explains why. Recent federal data shows U.S. mine production delivering around 1 million tons of recoverable copper, slightly down from the previous year, with most of it coming from Arizona. When people say copper matters, they're not just making noise. That there's a real supply chain concern underneath it all. Now here's where it gets even more interesting. This market is extremely sensitive to policy. Recent developments around potential U.S. tariffs triggered massive movements. Huge volumes of copper flowing into the country, premiums rising, and global stockpiles shifting. At one point this past winter, copper surged past 13,000 per metric ton as markets reacted to possible shortages and the growing race for strategic resources. Yes, copper is strategic. But here's the bigger question. What happens when strategic importance meets limited supply and rising global demand? The argument is real, but here's the part most people miss. Just because copper is important doesn't mean stacking shiny copper bars in your closet is the move. Pause for a second and think about that. There's a layer to this conversation that almost nobody talks about when they're showing off copper rounds on camera. Processing. Even when new supply comes online, processing remains a bottleneck. Recent updates show one major copper project in Arizona is only now starting to ramp up, while another massive U.S. project is still years away from meaningful production. And it doesn't stop there. There are still serious concerns about the economics of local, home-based copper smelting. It's expensive. It's complex. It's inefficient. When you hear people say, bring copper production home, that doesn't mean the entire system is fixed. It means one weak link is being addressed, while others still remain. Let that sink in, because this is why we need to be precise when we talk about copper. A strategic metal does not automatically mean it's a smart move for individuals to hoard it in bulky, impractical forms. There's a huge difference between national stockpiles and personal ones. Now, here's where things split into two completely different paths. If someone wants exposure to copper purely as a speculation, that's a different game. Now, you're talking about exploration companies, junior miners, drill results, financing, dilution, management execution, jurisdiction risks. That's not stacking, that's investing. And it's a whole different level of complexity. There's even been fresh news from a Nevada-based copper project announcing a new exploration season kicking off. Sounds exciting, right? But remember, that's a stock story, not a metal in your hand story, and people get into trouble when they mix those two worlds together. Now, let's bring this back to silver, because this is where things get even more intense. There is serious money flowing into silver mining stocks right now, but here's something seasoned dealers understand, far better than most online commentators: emotion. Because when silver starts moving, people don't just watch, they feel it. They walk up to the counter asking the same questions over and over. Should I buy now? Did I miss it? Do I wait for a pullback? Is this move even real? And here's the truth, those are not easy questions. In fact, the honest answer is one most people don't want to hear. Nobody knows what the next move will be. And the worst time to try and figure it out is when the market is already moving fast, because that's when emotions are at their peak, that's when decisions get rushed, that's when mistakes happen. Now here's a very real, very practical situation. You're about to place an order. Maybe it's the last tube available. Do you buy now? Or do you wait and hope for a better price? That's not theory, that's real. And the answer, it depends: your age, your income, your conviction, your ability to sit through being wrong for a while. Because here's something powerful. Patience is an advantage. If you have time, you have flexibility. If you can wait, you can survive volatility. But if you can't, then every move feels urgent. Every dip feels dangerous. Every spike feels like you're being left behind. Let me ask you something. Are you building something steady over time, or are you reacting to every move the market throws at you? Waiting is a powerful advantage, but only if you actually have time. Think about it. Two people can look at the exact same silver chart and make completely opposite decisions without either one being wrong. Why? Because time changes everything. Now let's come back to silver, because this is where emotions really peak. There isn't just one belief about where silver is headed. There are several. One group believes silver will rise over time simply because of inflation. As currencies lose purchasing power, hard assets tend to rise in value. Not every week, not every rally, but over the long run. It's a reasonable idea. Another group believes silver has been suppressed, held down by paper leverage, and is therefore far cheaper than it should be. And then there's a third view that the recent explosive move and the violent reversal prove something else entirely, that this market is tight, emotional, and unstable. So which one is right? Here's the uncomfortable truth. There's a piece of truth in all of them. But none of them, on their own, tell the full story. Pause and really think about that, because markets are never driven by one simple idea. Take the inflation argument, for example. If the value of money keeps getting diluted over time, then yes, hard assets like silver should trend higher when measured in that same currency. But that doesn't mean it happens on your timeline. It doesn't mean every dip is a buying opportunity, and it definitely doesn't mean every rally will continue. Now let's challenge another common belief, cost of production, that you'll often hear people say. If it costs this much to mine silver, then the price should be here. Sounds logical, right? But here's the reality. Price isn't just about cost, that it's about scarcity, demand, timing, liquidity, investor behavior, fear, momentum, capital flows, geopolitics, and one more thing people underestimate: how much buyers are willing to pay when emotions take over. So yes, cost can be a reference point, but it's not a limit. Still, there's a reason experienced traders come back to it, because it's something tangible, something they can hold on to in a world that often feels unpredictable. And in a way, they're not wrong, because while markets can drift away from reality, they can't do it forever. Now here's where things get really interesting. When someone says silver in the low 40s makes sense over time if gold stays high. That's not a promise, that it's not a prediction with a deadline, that it's a fairness argument, that it's an attempt to reconnect silver with a world we're already living in, a world where gold is elevated. Inflation still exists, and silver plays a dual role as both an industrial and monetary asset. And when someone says something like, a tube of Eagles could eventually be worth several hundred, that might sound extreme at first. But step back, not tomorrow, not in a straight line, not without volatility, but over time, you can at least understand the logic behind it. And this is where many people get it wrong. A target is not a timeline out of proportion moves. That's what silver does best. And that's exactly why this conversation matters, because when we step back from all the noise, the cleaner answer isn't about a perfect price target. It's this: the market can be undervalued and still behave wildly along the way. Now here's the real question you need to ask yourself. What kind of buyer are you? Are you the patient one, building slowly, accepting volatility as part of the journey? Or are you the one chasing vertical moves, afraid of being left behind? Because those two paths, they don't just feel different, they lead to completely different outcomes. Let's slow this down for a second. If you're the patient builder, there's something powerful to take from all of this. Don't let a massive wave throw you onto a beach you never intended to land on. Don't let one giant candle on a chart bully you into becoming a bad buyer. Don't let internet certainty rush your decisions. And most importantly, don't confuse excitement with value. At the same time, don't let every sharp drop shake your entire belief system either. You can believe in silver long-term without chasing it blindly. Now here's where the smartest lesson in this entire story shows up: the young buyer. Why? Because she has something most people underestimate: time. And time changes the game. Time allows patience. Time allows selectivity. Time allows learning. It gives you the ability to hold cash and wait. Buy when things are quiet, instead of when everything feels urgent. Understand premiums, products, cycles, even dealer behavior. And here's the part many people forget: time allows you to be early and still win. That's a massive advantage. Now think about the people who actually succeed in this space. They're usually not the loudest. Not the ones making the boldest predictions. They're the steady ones, the observant ones, the ones who take the time to understand the difference between the metal itself and everything wrapped around it. They learn to separate a short-term stampede from a long-term accumulation strategy. They learn when pressure in the market is real and when it's just fear being amplified online. And in the end, that matters far more than what happens in a single week. Now let's zoom out one more time, because there's another lesson here, one that doesn't show up on charts. The shop.it survives on price, yes, but also on something deeper: goodwill, trust, relationships. customers who send cards, people who understand delays. A business adapting to real-life challenges, like injury, limited capacity, or simply needing a day to stay organized. That might sound small compared to billion-dollar trades and market squeezes, but it's not at its foundation. Without that foundation, everything else is just noise. So where does that leave us? Let's be honest. Is silver likely to be influenced by big players, leverage, and bursts of speculation? Yes. Very likely that's the nature of this market, but is every move controlled by one mastermind? Much less likely, because markets aren't clean, they're messy. Motives overlap. Forces collide. Sometimes things are engineered and sometimes they're just unstable. Often it's both. But here's what actually matters going forward. We're in an environment where silver still has real structural support. Physical demand is rising. Interest from investors hasn't disappeared, and its role in industry continues to grow. So let me leave you with this. In a market that's emotional, volatile, and sometimes confusing, are you reacting to every move, or are you building something that can survive all of them? This is where everything comes together. Silver matters. Even if some sectors cool off, the bigger picture is still there. But at the same time, this is a market that's small enough to stay emotional, crowded enough to get squeezed, then thin enough to punish anyone who shows up late. And that's why it feels like brilliance one week and chaos the next. So what's the answer? Not to become numb. To become precise. Be precise about what you owe. And be precise about why you own it. Be precise about whether you're buying coins, bars, funds, or mining shares. Be precise about your time horizon. Because here's the truth most people overlook: an asset can be a strong long-term play, even if the short-term market around it looks like a complete circus. Now let's address something a lot of people are waiting on: regulators. It's understandable. People want someone to step in and fix things, to draw a line, to say enough. And maybe that happens, maybe oversight improves, maybe bad actors get exposed. But here's the reality you need to accept: your strategy cannot depend on that. Don't build your plan around the hope that someone else will fix the system right on time. Build a plan that works, even if they don't. Let that sit with you for a second. Now, step back and look at the full picture. The headlines about silver? Real, the rally? Real, the crash? Real, the controversy around big players? Real, the strategic importance of copper? Real, the long-term inflation story? Real, the public interest? Real, even the frustrations, the delays, the small business struggles, the kids saving birthday money for silver. All of it is real. But here's where most people go wrong. They try to reduce everything to one explanation. It's all fake. It's all manipulated. It's all controlled. That's too simple. The smarter way to see it: this market is layered. Part scarcity story, part policy story, part leverage story, part psychology story, part trust story. And once you see those layers, you stop getting hypnotized by any single narrative. Now here's the practical takeaway, the part that actually matters for you. If you're thinking long-term, worry less about proving a conspiracy and focus more on becoming a better buyer. Watch premiums, watch timing, understand what you're buying, respect volatility. Use patience as a weapon, not a weakness, because even in a noisy, emotional market, discipline still wins. Now here's the final thought, and don't rush past this. Things are likely to get even more interesting from here. Metals may continue their long-term path, but at the same time, distortions, fast money, and volatility aren't going anywhere. Both realities can exist together. Don't wish for chaos just because you think it will send prices to the moon overnight, because moves like that, they usually hurt the small players first. What you actually want is something different: fair repricing, healthy price discovery, clarity when everyone else is losing theirs. And remember this: the moment a move feels obvious, that's usually when discipline matters the most, because silver has a habit of punishing both blind fear and blind greed, right when people are most vulnerable to both.